Hi, thank you. I'll just share my screen before I begin. Yeah. Hi, thanks Aisha for the great introduction. And hello everybody. Happy New Year in advance to all of you. So as Aisha mentioned, I'll be speaking more about the financial goals for 2023 and what are some basic tips which you can follow and some important hygiene things which you should have it in your investment journey for the future whenever you want to achieve your goal. So that is today's agenda, and I'll begin with it now. So first is I would like to begin with the basics, and it's kind of fairly intuitive, like how should you set realistic financial goals. Now, before beginning, you'll get some polls, some basic questions which you'll have to answer. It's a yes or no, and I can see that the first question has already arrived. Great, and I'm seeing a lot of responses. It's kind of good, like more than 40% people have planned for their financial goals. Oh, it's more than 50% now. Great. That's nice. Okay. Okay. That's good. I'm ending the poll now. So as I could check, uh, more than 50%, 52% people have almost probably saved for planned for their goals. I'm not sure whether you have started investing and saving for the same, and you can always drop it in the chat box if you want to share as to how you're probably saving for goals and investing for them as well. If this conversation is if there's a good contact between the viewer and the audience and the speaker, it will get more interesting as well. So probably drop in some things if you would like to share about your goals and how your investment is going on. Okay, so we'll begin with setting realistic financial goals and some importance around it. So the first important step, like financial setting up a financial goals is kind of very important because it makes you financially independent and secure as well. So if you are not working for any specific thing in your life, you're not saving and investing for a specific thing, what can happen is you might do some unviable spending. You won't be able to make up for some unexpected bills that might come. Probably you won't be able to save for a good term plan insurance or something like that. So that's why setting up a financial goals is quite important, as it helps you become independent. Okay. Now, whenever you set a financial goal, it's important that you include your immediate family members as well. And why I say this, because they have seen more seasons than you. They've experienced a lot, and probably they know how things work and how future holds. So keep your family members in loop as much as possible. The next point is your goal should be achievable and realistic. So when I say realistic and achievable, it means that the return expectations that you have after setting up the goals should be realistic. Now, historically, equity market returns in India have been around 10 to 13%, a median of around 11 to 12% in the last 20-30 years. So if you're setting a goal, have an expectation of not more than 12 to 13% of returns per annum for achieving your goal. And that also if you're an aggressive investor. If you only like to invest in fixed deposits and other government small saving schemes, you should probably set up a goal which can give you a return of not more than 7 to 8% per annum. So in short, it should be kind of achievable and quite realistic. You cannot set a goal that is not achievable, which wants you to earn a return of around 20, 25, 30% per annum for the next 25, 30 years. Okay, that is thing. The last thing which I wanted to share while setting up financial goals is that you should be a bit more specific while setting up goals. You should have a clear timeline kind of thing. And you should be, so if you want to save for your retirement, why do you want to save for retirement is one thing which you should have it in your mind. So probably you can say that I want to save my life. I want to save and invest for maintaining my retirement lifestyle. So you should be specific about why are you saving for your goal, and probably that will give you a more concise approach while setting up your financial goal. The last thing is that what you should do is basically, after doing all this, you should basically you should do a periodic review of all the goals that you have set. Are they realistic? Have you followed an optimal approach while setting up the goals? So periodic review every year, probably in the last month of every year, is a recommendation. The next part where I would like to come is where I'd like to go is about some steps for setting up a goal. So this kind of is a goal-based investing approach, which Tavaga also follows. So what we do over here is we onboard a client or an investor. Then what we do is we probably ask for his personal information like his name, his age, and stuff like that, his basic KYC. And before giving any recommendation on where to invest, how to invest, we first ask the investor as to what is the ability and willingness to take risk in the market, right? Because if an investor doesn't like the volatility and the ups and downs that happen in the equity market, probably that investor is not suitable for equity market investments, right? So that's why gauging the risk appetite of an investor is quite important. And there's no right or wrong in this. Probably every investor doesn't like equity. So there are few investors who don't like fixed deposits at all. They only like to take high risks. So that's up to a particular investor. But gauging that is the first step that we do. After that, we come to goals. And when we say we come to goals, we ask them for the goals, and we ask them to categorize them in short, medium, and long term. Okay. So our more focus and recommended approach is towards long-term goals because they are more achievable than short or medium-term goals. That said, there can be one or two short, medium-term goals which one would like to achieve. But this layering of goals into various baskets, it's quite important because selecting the instruments, it helps in selecting the instruments for achieving these goals. Okay. For example, a short-term goal can be probably saving for emergency funds. So you want to allocate a good amount of money in your emergency fund. So you can probably save it in the short term and you can keep that money likewise. But you want to save for the emergency fund as soon as possible because an emergency can come anytime. A medium-term goal can be around you want to purchase a car in 3 to 4 years. So you're saving for that particular car or something like that. A long-term goal can be saving for a retirement lifestyle, or if you're married, then saving for a children's education. And if you're unmarried, then probably saving for your own wedding, or you want to go abroad, you want to do a world tour after 8 to 10 years, something like that. Okay. After setting up the goals and categorizing them in short-term, medium-term, and long-term basis, the next step is to set up a target date. Now, when I say setting up a target date, it doesn't mean that you want to achieve a goal on a particular date of the month. Okay, there can be some flexibility around it, but ensure that whichever date you select, your investments are around that month only. So probably 2-3 months here and there, that's fine. But having that clear target in mind is quite essential because without target, it's mostly impossible to achieve that particular goal. Okay. Now, after doing all this and before starting to invest in for these goals, you must be having some investments in savings bank account, or you must be having some gold, or you must be having some real estate or something like that, which you have purchased for investment purposes in the long run, right? You can attach those investments to your goals, and likewise, your amount required to achieve the goal can reduce. So layering in the current state of savings is what I meant over here, wherein you can ensure that your current savings can be used for achieving the goals that you have made, right? And I repeated it in the last slide as well, kindly ensure that you do a periodic review after probably in the last month of every year. Okay, this helps you to stay on top of everything. Some additional simple steps and some hygienic things, and these are fairly intuitive, you must be knowing already, but the real skill and magic is to bring these theories into practice, is what I feel. So simple stuff, you can write your goals. Now what we generally recommend to our clients is write them on a post-it or some paper and stick it on your wall or something like that, which doesn't spoil your decor or something like that, but write them down, keep a note of it, always have them in your mind. Okay. I said it in the past, make them specific. Okay. Be more specific, as much possible. So that will help you to achieve the goals. Give yourself a deadline. And not only to achieve a goal, not a target, but even to make a goal, give yourself a deadline. You cannot just postpone making a goal. You have to make a goal as soon as possible. Okay. And in the last, make sure that they are your own goals. Now you must be interacting with many people on a daily basis, your family members, your colleagues, your cousins and stuff like that, your friends. Okay. Now they must be talking about their goals, what they want to do in the future, what they want to save for. Probably you don't have, and not probably, but most of the times your goals might be different than what they have. Okay. And because like someone has a good someone is good, he's doing well, maybe you are in the mediocre category, or maybe you're doing well. So there are different aspects to making goals, and that's why it's important that you are saving for your own goal, and not, you're not just copying somebody else's goal and making that your own goal and saving for it. Okay. Now, there might be a situation where you don't have any goal in life, and that is also completely fine sometimes. Okay. Because maybe you're rich. The only goal that you have in your mind is you want to maximize your wealth, and you want to save you want to preserve your wealth and probably maximize it as well. So even if you don't have any goal, even after trying, even after thinking for a lot of time, you don't come up with a goal and stuff like that, it's completely fine. You can just, you can say to yourself that I want to just maximize my goal over the long term. Okay. So that's fine. Moving on to the next slide. Now we have spoken about how to set some financial goals which are realistic in nature, and we have also seen how to set them, right? The steps, the goal-based investing step. Okay. Now I will tell you about how you should stick to them and what is a simple hack around it, and probably it's quite achievable as well. I'm not sure whether how many people know about SIP and some jargons related around investments, but it's quite famous. You must be hearing, seeing a lot of ads on various TV channels around mutual funds, and they give importance around SIPs. So systematic investment plan, which is also known as SIP, is one of the best tools that the Indian mutual fund industry has come up with. I'm not sure whether it's as popular as outside as it's in India, but I'm sure that everybody almost who's exposed to investments knows about SIPs, right? So how this works is basically every month from your savings bank account, systematically a part of the savings is transferred to an investment vehicle that you have chosen to invest in, right? Now, what happens is you don't have to time the market every month. You give a standing instruction, like when you pay your bills, you have to just give a standing instruction in the beginning, and every month an automatic SIP gets debited from your bank account into the investment vehicle that you have chosen for. And it's as the name goes, it's quite systematic, right? Because you're in a diligently and in a disciplined manner investing every month, in an investment vehicle. That investment vehicle can be a stock, an equity share, an equity or debt mutual fund, or probably it can be a recurring deposit as well, an RD. Okay. The next thing is around STP. Now, STP is kind of similar to an SIP, but STP is meant for an other class of investors. There are people who already have a lot of money in their bank accounts, and they want to park it somewhere, right? But it's not always recommended that you park your investments directly in an equity mutual fund, because probably it's not a very good level to park in. You're confused as to where you should park that money. So the better way, if you have lump sum money in your bank account which you don't want to use for the next 3 to 5 or 7 years, or you're just saving for it, then the better manner is to park that money in a liquid fund. Okay. A liquid fund is kind of similar to a savings bank account, but it is tax efficient than savings bank account. The interest rate that like the returns that you get on a liquid fund are a bit higher than savings bank account. So today, if I'm not wrong, a savings bank account gives around 3 to 4% max. In a liquid fund, you get around 6 to 7%, thanks to the rise of interest rates in the last 6 months, 3 months, right? So STP, in short, you transfer your money from lump sum money from your savings bank account to a liquid fund, which is similar to a savings account. And from that liquid fund, automatically every month, you should give a standing instruction to park that money in an equity mutual fund or a debt mutual fund, wherever you wish to invest. Now, again, what happens is that money is not in your savings bank account, so you're not going to spend it. Okay. But ensure that you transfer that money only, which you are not going to need for 5, 7 years or for your before your goal. Okay. If you need that money before your goal, it's not advisable to transfer that money to a liquid fund and then to an equity mutual fund. Okay. The last hack and the last tip around where you can probably like how you can stick to your goals is you need an advisor. Now, for every profession, there's a professional, right? There's a doctor, there's a mechanic. So even for investments, there has to be an advisor because it's quite surprising in India to see that most of the people take advice from their friends and colleagues and family members who are not probably authorized, regulated. They're not allowed to give advice, and still that happens. It's okay up to a certain extent until everything is known. Like if your family members are their financial advisors and stuff like that, it's okay for them. But if you're just taking from a person who's not into financial advisory background, then probably you're not giving the justice to this profession, and you're not giving justice to your money that you're investing, right? So subscribe to the services of a SEBI registered investment advisor. RIA means registered investment advisor. Now, to get an RIA license in India, it's quite difficult because there are a lot of things which a person should follow. Probably he should have good experience in financial services. He should have good qualifications with respect to education and stuff like that. So SEBI doesn't just give any license to anybody. So that's why advisory license is something which is quite precious in India, and you won't believe there are not more than 1,000 RIAs in India right now. It's around 1,000 only. And since like people have started investing since 30 years and still we have only 1,000 RIAs. So Tavaga is one of them. So always subscribe to the services of a SEBI registered investment advisor. It will help you a lot. And the last point around this is that RIA should not only focus on stock investing. Okay. He or she should probably give you an entire background around wealth management and portfolio management and not only stocks, because I've seen that there are many RIs who only deal in stocks, and that should not happen because stocks don't necessarily work well in the long run. Okay. Moving to next slide. I want to cover about how investment objectives and goals differ between individual investors and institutional investors. Institutional investors are same like the institutions that we have in India. Like, for example, an LIC is an big institution. Unit Trust of India is an institution. They've got a lot of money which they want to park somewhere, or they want to park somewhere to give out any liability which can arise in the future, or they want to maximize their wealth or something like that. But differentiation between goals of a retail investor like you and me and in big institutions. Okay. I'll come to that point where I'll tell you as to why I've made this differentiation at the end of this slide. So retail investors, basically their goals are and investment objectives are quite diverse. Sometimes they are not clearly defined and quantified. Uh, they are not more specific, as I told you many a times. If you compare with institutions, they have clearly defined objectives. Sometimes they're required by law to have an objective as to which liability they want to cover in the future. With retail investors, the investment objectives can change over time. Probably you want to buy an Audi, or you want to buy a Range Rover instead of a Maruti car or something like that. So for a retail investor, your goals can change over time, and by changing from Maruti to Range Rover or Land Rover, your amount of investment required and your goal amount is going to eventually increase, right? With institution, that's not the case. If they've said something in their IPS, that is policy statement, it's going to remain. It's not materially going to change over time. With retail investors, I have personally seen in my advisory journey that the goals are relatively short. And when I say short, even the time horizon of less than 7-8 years, I feel it's short, because equity markets, if you're an equity investor and if you love equity investing, and probably if you want to earn a good sizable return from it, then even 7-8 years could be short. Okay. A probably good investment horizon for an equity investor can be 10, 15, 20. Now I've seen some few people who have been investing in equity markets since 30 years, and they've been investing in mutual funds only. And the compounding journey that has happened is quite surprising, and it was a good education part for me as well, knowledgeable part, right? So for retail investors, the goals are really relatively short, which shouldn't be. And for institutions, they are relatively long, and they long as in they go up to 30-40 years as well. From all this, we have seen that retail investors, because of all these, are sometimes less sophisticated with respect to their investment journey. The sophistication part is missing. With institution, there's a higher level of sophistication. They're quite regulated. They're required by law to have various investment committees and stuff like that. They're investment members, board members, who are only responsible for probably investment part of their portfolio, right? So they are more sophisticated sometimes. Retail investors are vulnerable to a lot of emotional decisions. And when I say emotional decisions, these are psychological biases. And I believe that psychology plays a greater role in the equity market journey, at least. Okay. Sometimes in fixed deposits as well, but mostly in equity markets. Because today a stock has gone down 10% and probably you sell it off just because of just out of the fear that it might go down tomorrow as well. Now, this is an emotional decision. You're taking a decision just because it has gone down 10% today, right? You're not checking the fundamental or a technical aspect as to why you are buying or selling it, right? So you're vulnerable. So retail investors are vulnerable to emotional biases. With institution, there are proper checks and balances. I mentioned just now that there are investment committees, there are members around the investment committees who are responsible to ensure that there are no decisions taken in haste and out of emotions. The whole point of talking, giving you a differentiation and between retail investors and institutional investors is that how institutional investors are probably more have a formal governance structure. They have a formal approach in their investment objectives. Comparatively, retail investors do not have it, and this is not only the case in India, but it's seen everywhere around the world, right? So every retail investor should have that in mind, that they should have an approach to become and save like an institutional investor for long term, right? You should have a relatively longer goal. You should have relatively longer goals. You should have your objectives and goals should be clearly quantified and defined, right? And probably a SEBI registered investment advisor again can help you do that, right? So target becoming like an institutional investor in the longer run. The next technical aspect where I would like to touch upon is glide path investing. So the initial phases that we have seen around this presentation were a bit intuitive. You already knew a lot of stuff, and probably I was just emphasizing on how to bring these theories into practice. Now, the later half of this presentation would be a bit technical, and you can always drop things on the chat box, and I would be very happy to answer it at the end. Or I have a colleague who's attending this call as well. He or she can probably drop your answer in the chat box as well, right? But keep the conversations open, like clear all your doubts. You can always reach us on our email ID, which I'll be giving you at the end as well, right? Coming to the glide path investing part. Now, say for example, you're saving for your goal, which is 7 years from now. Okay. What you will have to do is, if you, and I'm assuming that an investor is aggressive in nature, so he likes investing in equities, he likes to take a bit of good amount of risk and stuff like that. Okay. So in the initial years, you'll obviously invest in equity markets because equity markets have the highest potential to help you in achieving the goals, right? So you invest in equity markets in the initial journey, but as time, like once, if assuming it's a 7 year goal, after 5 years, you're probably near to your goal. You've saved enough, more than like around 80 to 90%. But you also need to ensure that the money that you have saved and the return that you have generated by investing in equity markets for the first 3 to 5 years of your investing journey for a 7 year goal needs to be preserved. If the capital gets eroded in the 6th year after saving for 5 years, there was no point in just saving for the last 5 years, right? So that's why, in order to preserve your capital that and the return that you have generated, you should transfer all the money that you have in these instruments to a risk-free asset. When I say risk-free asset, it can be a liquid fund again, or it can be a simple fixed deposit, a short-term fixed deposit probably, which will give you all the money that you had generated in the past, plus an additional return by investing in these risk-free assets at the end of your goal time horizon, right? So basically, in short, glide path investing just suggests that we already know that the market movement is not in anybody's control. So we saw it during COVID that people who were investing in 2016, who have been investing since 2016, probably they were at the same levels in 2020 because the equity markets crashed in 2020 as a result of COVID, right? But people who invested in 2016 and they transfer some of their profits to risk-free assets in 2019 or 2018 or something like that, they preserved their returns, right? Market movement, therefore, is not in anybody's control. We can have a lot of volatility. Now, For example, European markets have not given a good return in 12 years. Of course, they are developed. Indian markets, there was a time when Indian markets did not perform at all since 1993 to around 2001 and stuff like that. So there can be times where even equity markets fail to give you return, right? So that's why keep a good asset allocation and keep on preserving your capital and the returns that you've generated. Reiterating again that you're changing your asset allocation strategy whenever you're near to your goals. You're kind of declining your allocation to risk when you're approaching closer to your goal. So initially you invested a lot of money in your equity markets, and now you're now you're shifting to risk-free assets. You're declining your allocation to risk. I'll touch upon this right now as only that the one of the best tools to implement glide path investing is target maturity funds. Now, target maturity funds are index funds that are passive in nature. Now, there are a lot of jargons that I use right now, and I'll try to explain you, and you can always ask any doubts if you have. Now, when you invest in the mutual fund scheme, you give your money to a fund manager, and that fund manager does his or her own due diligence as to which stocks to buy and which stocks to sell and stuff like that. He does his own research and everything. With passive funds or index funds or ETFs, the fund manager doesn't apply his own skills, or he doesn't use his own research or due diligence while buying or selling anything in the portfolio or in the mutual fund scheme. There is an index like Nifty 50 and Sensex BSE 30 are two indices, famous indices, everybody must be knowing. They just invest in that particular index as per the allocation to that a particular stock. So for example, if Reliance makes up for 15% of Sensex, then they will put 15% of their money in Reliance. Likewise. So target maturity fund is not an equity fund, but it is a debt fund. It is like a fixed deposit fund. Okay. It's similar to fixed deposit, but better than fixed deposit. So what target maturity fund does is, when you invest in a target maturity fund, you kind of lock in a certain amount of return, which you can generate if you hold this particular mutual fund till maturity. So if the interest rate that you're locking in today is around 7.5%, then if you hold this fund till its maturity, it can be 2 years, 1 year, 3 years, 5 years, it can be 15 years as well. You will get that 7.5% at the maturity, irrespective of how the market moves, how the inflation goes, and how the interest rates move. It's kind of a stable and predictable interest rate bearing instrument, right? It's very simple. You have to just buy that in lump sum, and you have to just hold it till maturity, and you will get interest. You'll get a return around that. Okay, this is a good part to implement glide path investing. Probably when you're near to your goal, you can just transfer all your money into that short-term target maturity fund, and you can achieve your goal. Now, this was all about goal setting, some jargons around glide path and investing. I'll come to risk management, which is very important because investing is not only about returns, it's also about risk management, and also touch upon some techniques as to how you can plan for your retirement goal. I'm not sure whether a retirement goal should be a priority right now, but retirement goal is going to be a priority of everybody or their family members. So just it's quite important to have this discussion with you. So some basic things, like before taking into consideration as to how do you plan for retirement or how do you manage risk better, we want to first know what are the different risks that can come in our life. Okay. Premature death, it's intuitive, fairly intuitive. Premature death, like unfortunate incident, you die a bit early, or you die in your early age, or even later. Health risk, we saw during COVID that how health was one of the biggest factors of our life, and how preserving it and taking care of yourself was important. But always there's a health risk which is going to come always. Okay. And the last point is longevity risk. Now, longevity risk is something that is going to come in India as India progresses and improves, right? Longevity risk simply means that a person is expected to live longer than he was expected 10 years ago. Say, for example, earlier the average life expectancy in India was around 75, 80 years. It might touch 90, 95 because of improvement in healthcare services. We don't know, but it can happen at it might happen. Like, I personally believe there's a high probability that India will improve on the health parameters in the coming years, and probably because of that, the average life expectancy is going to increase. Right? It's already happening in the developed markets. It will happen in developing markets as well. Right? Now, to ensure that the risks that are identified, like if you want to take care of all these risks, you can just transfer these risks. Okay. Now, when I say transfer, probably you can have these two instruments uh, in focus. And it's not compulsory that everybody should have these instruments for saving and investing for your risk, but they are recommended, not compulsory. Right? So in order to take care of the first two risks, that is premature risks and health risk, simply buy a term plan for premature death. And for health risk, you can buy a medical policy. Your company gives it, or you can buy one from an insurance company as well. Ensure that apart from these two policies, you don't buy any other insurance policy which is meant for investment purposes, because insurance is not for investment. Insurance is for taking care of your risks only. Okay. Insurance should be only used for death purposes, for against death and against health risks. Okay. You don't have to buy a policy which you invest every year, say 2 lakhs, and after a certain point of time you will get a certain income. There are a lot of policies that are going on these days. Okay. This is not an instrument, insurance per se. The second point is you can transfer your longevity risk to an annuity. Now, annuity is something that is not quite known in India, but it's more seen in developed markets, because developed markets have more life expectancy and annuities play a greater role. But we are seeing the emergence of annuities in India as well. And I can give you an example of annuity, because you all must be working somewhere. You all must be saving for saving in a national pension scheme or something like that, for tax purposes or anything, and that is an annuity. So what annuity does is, you pay every month, or you pay a fixed amount in lump sum right now. After your retirement, you start getting a pension. Okay. And that, in simple words, that is annuity. Okay. It's not an insurance, it's an annuity. Again, it helps you in generating income after your retirement. Okay. It gives around 7 to 8% and something like that. Pradhan Mantri Vaya Vandana Yojana, National Pension Scheme are some examples of. National Pension Scheme is a mode to turn to annuities. Of course, it's not an annuity per se, but annuities help you in generating income post your retirement. And the earlier you invest in an annuity, the better it might be sometimes, depending on the annuity you select, because you give more time for your invested money to compound over a long term, right? And you can always make adjustments if required. Like, you can always not buy an insurance, you can always buy an insurance, you can always go for an annuity. All these decisions are recommended to be taken after consulting a registered advisor, because he or she knows more about all these things. Because yeah, coming to the investment part, and I'll tell you about how retirement goal planning can help, and other goals can help, like investing in various assets can be of help in your other goals as well. So there are around 5 to 7 asset classes in total, which are fine for retail investors to invest in over the long term. Now, probably this is cash, which everybody must be knowing through the shape. Now, in cash, by keeping cash, you earn 0 to 4%. Now, this is not the cash that you keep it in your wallet, but this is a cash by where you invest in a short-term bank FD, which is of 7 to 14 days or probably 1 month or something like that. Or it can be a short-term treasury bill issued by the government of India or the RBI, which is there for around 30, 60 days, 90 days. So this is kind of liquid cash only. You can sell it anytime, you can withdraw anytime, or a recurring, yeah, something like that. Right? Now, this is this looks like a piggy bank, and this is a form of savings only. This is a fixed deposit thing which you're seeing around 6 to 9%, which is giving you a return. Now, fixed deposits pre-COVID-19 gave a return of around 8%, 8 to 9%, and we are back to 7.5 to 8% now, right? So this is fixed deposit. Now, this instrument which has which has a hand giving a return of 7 to 9% is a fixed income mutual fund, or a debt mutual fund, as we call it, right? So a debt mutual fund is kind of similar to fixed deposit. It's sometimes risk free, but it might not be completely risk free in the short term, but it works in a similar way like a fixed deposit works. Okay. The only differentiator between a fixed deposit, a good differentiator between fixed deposit and a fixed income mutual fund or a debt mutual fund is that a debt mutual fund is more tax efficient if you hold it for more than 3 years, right? Because when you sell a debt in mutual fund after 3 years, the inflation that has occurred in the last 3 years when you invested is also taken into consideration, right? And that's why debt mutual funds are always recommended instead of fixed deposits, even for investors who don't like capital markets, because debt mutual funds are kind of risk free, especially short-term mutual funds, short-term debt mutual funds, and they probably give you a good return without much risk. Okay. The next is gold. Now, the returns of gold have been quite volatile. And when I say volatile, it's not like they go up and down like equity markets. Sometimes gold gives you good returns in a particular year, sometimes it doesn't give you. We saw the importance of gold during COVID-19. In COVID, gold generated probably more returns than equity in the initial phase in the first 6 months of the COVID-19. Investors who had parked around 50% of gold have beaten a lot of well-known investors in the market as well, because gold did perform well during COVID, and gold will again continue to perform well if there's any recession or there's a extreme economic scenario in the economy or in the global economy. So gold is an asset which takes care of your investments against extreme economic scenarios, in simple words. Surprisingly, in the last 1.5 years, gold has done well than Nifty and Sensex, right? Not many know, not many speak about it, but gold ETFs, and I'll come to that part, gold has done well than equity markets in the last 1 to 1.5 years than the Nifty Sensex, right? The next is real estate. Real estate was kind of okay in the earlier times where the investment opportunities were and the options were limited, and real estate was one of the options along with gold and fixed deposits. But now, as property prices have gone up, the interest rates have again started to go up. The interest around real estate has again gone down, right? So buying a real estate property on loan and for rental income is not recommended at all. In the past, it has generated around 6 to 7% returns, but in future, it might not give you. A good alternative to real estate is real estate investment trust, also known as REITs. Probably if you contact us or if you come back to us, we can help you in making understand what are REITs, because it's not possible to explain what are REITs in this particular presentation. But REITs is a good alternative to real estate, and it gives you good dividend as well. The last one is equities, and the most loved product of millennials these days, especially post COVID, because it has given very good returns if you compare it with the lows it touched during COVID. Yeah. So I'll just move on to the next slide now. You're getting a poll right now, and you have to answer as to which asset classes do you invest in, or have you invested in the past, or probably you invest in the future. Yeah. Oh, I see a lot of people investing in equities already. That's great. The poll is running. Around 55 out of 78 people have answered. Probably I'm ending the poll right now. Great. So I can see that close to 64% of the people have invested in equities, and they invest in equities. And there's a very small percentage of real estate investment, and that's really very good, because real estate is not an investment. It's only for you to stay in the stay. You want to stay in a house. So yeah. So that's really very good, because in the long run, equity instruments can do well than any other instruments. I'll move on to the next slide. Because all the audience invests a lot in equities, and so I'll probably give a good primer on various instrument suitabilities around your goals. I'll start with long-term goals because I believe that these are the most important goals which you want to have in your life. Long-term goals are generally categorized as more than 5 years, and it can go up to 20, 30, 40 years as well. Okay. So for long term, the good instruments to invest in are and recommended are equity ETFs, index funds, flexi cap funds, target maturity funds, and gold ETFs, right? So around ETFs and index funds, I've already given a primer. A fund manager doesn't do his or her own due diligence. He just invests in a index that is being prepared by Sensex or Nifty or the exchange, right? There's no mind which is being applied by the fund manager. There's a proper index that has already been prepared by the stock exchange. The fund manager just invests it, mimics it, and invest your money in that. These are fairly better instruments than actively managed instruments. Actively managed instruments are those wherein an investor does his or her own research, due diligence, applies his mind, and then invests your money in that fund, in that scheme. For actively managed funds, the fees are comparatively higher than index funds and passive funds, and that's why. And they, after doing all the research and stuff like that, all the due diligence, we have seen many a times that the active managers don't do well than the ETFs and index funds. So what's the point of taking higher fees when you're not able to generate quite a good return than ETFs and index funds? So that's why we at Tavaga have always recommended to park maximum money of your equity investments in ETFs and index funds, right? For people who are hellbent on investing in actively managed funds, which is fine up to a certain extent, if you've done proper due diligence, if you know the fund manager well, if you know the fund house well, and you know the policy statement around your mutual fund investment, active investment, then a flexi cap fund is a good fund to go for. So flexi cap fund, what it does is there are a lot of stocks available in this market. Some are small, some are mid cap, some are large caps, some are international stocks as well. So what does a flexi cap fund do is it invests in all category of stock, irrespective of its size and style, right? It is not only exposed to large companies or mid cap companies or small companies or international companies only. A flexi cap fund is a mixture of everything. Okay. So this is a better instrument if you're not willing to go with passive instruments such as ETFs and index funds. Again, there are few investors who don't like to invest in equities at all. Okay. Even if the investment horizon is long term, for them, this target maturity fund that I explained, which can give you a stable and predictable return even in the long run, is good, right? This is a debt index fund. It's a risk. It's kind of a low risk product, but it is only recommended to those investors in the long term who don't like to take risk in the equity markets. Along with all these instruments, gold is a good asset to have it in your portfolio. On the medium term segment, again, I've included target maturity funds as well in this because there are target maturity funds around 3 years, 5 years, and around that horizon. Equity hybrid and conservative hybrid are funds, are schemes which are again active, but comparatively they have a lower expense ratio or the fees that are charged on a mutual fund scheme. They are a mixture of equity and fixed income. In short, you don't have to separately buy a equity fund or separately buy a debt fund. If you buy an equity hybrid fund or a conservative hybrid fund, it's completely fine. Now, nothing is a recommendation per se. Everything is, I'm just giving a primer on which schemes are suitable for different time horizons. Again, gold ETFs is a good addition to your medium-term goals. For short-term goals, keep your money invested in those instruments which are liquid in nature, in which you can take out your money easily whenever you need whenever you want to achieve that goal. So liquid funds, as I mentioned earlier, target maturity, short duration funds, which are short term in nature. In short, these are debt funds again. Short term bank fixed deposits, 15 days, 20 days, 1 year, 80 days, something like that. Treasury bills is kind of a debt instrument. Like, you know that you probably know that you can invest in a stock from a stock exchange through a broker and demat account. A treasury bill is something that is that can be purchased through RBI. Okay, it's a debt product basically. Now, instead of buying a treasury bill, you can put your money in liquid fund. Liquid funds eventually invest in treasury bills only. Treasury bills are not easy to buy compared to liquid funds, and that's why it's recommended to go via the first four options rather than with treasury bills. Okay. For short-term goals, it's mandatory that you don't have an exposure to a lot of equity at all, because equity markets are volatile. They can move up and down in short term horizon. You don't have any control over the volatility, and that's why your goals, you might not achieve the goals in the short term if you have a lot of equity in the portfolio. That's why equity is not generally recommended for short term goals. Again, we touched upon the importance of gold and how it can help you in achieving the goal in the previous slides. I would just like to give a basic primer on which are good gold instruments to park your money in, because I saw that not many people invest in gold, and gold has given good returns in 2020 as well as 2022, and it has beaten the Nifty. So this can be a good value addition to you, is what I feel. So probably you can think upon it. People like our family members, our grandparents, our parents have been investing in gold through the physical gold way, right? You buy gold coins, you go buy gold bricks, you buy jewelry. But don't you think that like these are difficult to store? You need to go to a bank, buy a locker, like rent a locker. You have to pay the annual fees. Again, these bank employees also insist on taking a fixed deposit against that locker, which is of low interest rate. So there are a lot of complications involved around buying gold. Again, there are a lot of making charges. There's GST attached to it. So rather than going with the physical gold route, why not buy an alternative where it's comparatively hassle free, right? RBI came up with sovereign gold bonds in 2015, wherein you can invest in that sovereign gold bond, which is issued by the Reserve Bank of India. It's Central Bank of India, so you don't have that risk in the portfolio. By buying sovereign gold bonds, you also get a 2.5% interest on the sovereign gold bond that you buy. Now, how a sovereign gold bond works is if you purchase it for 5,000 rupees and gold price went up by 20% in a year, so your sovereign gold bond price will also increase from 5,000 to 6,000, around 6,000, right? The maturity is around after 8 years after the issuance. So if you purchase in 2053, the maturity is going to be in 2023. It's an 8-year product. The best part about this product is that if gold has appreciated in the last 8 years, then and after 8 years you're selling that bond to the RBI back again, then you don't have to pay any tax. You have to pay zero tax on the income that you have made through gold, through sovereign gold bonds. You can always give it back to the RBI before 8 years as well, but it's not recommended. You can be liable for tax if you give it before 8 years. Okay. The other way is to go via ETF. As I mentioned back then, ETF is a passive investment fund. The fund manager simply purchases what is there in the index. Okay. Now, gold can also be purchased via ETFs. It's a low investment products. You can sell it anytime after purchasing it. And there are no making charges. There are no storage charges. And if you're going through a discount broker, you don't have to pay any brokerage to buy an ETF as well, right? I just forgot to mention a differentiation between an ETF and an index fund. They both are similar products, just that in an ETF, you can buy it via demat account. For an index fund, you don't need a demat account. You can just go on the mutual fund website and buy it from that website, right? But these both products are similar and one of the best to take exposure to overall capital markets, equity, fixed income, gold, everything. Now, when I said initially that financial goal for 2023, I never gave out any goal per se. Like I never mentioned that this should be your goal or something like that. And I would like to touch upon it right now. The only goal that you need to have in your life for 2023 and beyond with respect to various investments, apart from the financial goals, is getting the asset allocation right to achieve the goals, right? You might be having a lot of goals in your mind, a lot of investment objectives, things in your mind, but to achieve that, you need to have right set of assets, okay? Right set and an optimal set of allocation to those assets. Otherwise, you're not going to achieve that goal. So the one thing that you need to ensure is that you have a good amount of equity, the right set of fixed deposits, and the right amount of gold in your portfolio for achieving goals. Always remember this slide, which I spoke about short-term, medium, and long-term goals. Never buy equity for short-term goals. Keep very limited exposure for medium-term goals, And for an aggressive investors, have a large amount of exposure to equity in the longer term zones. Around 80% to 90% of equity is a must if you have a goal beyond 6-7 years. So that's it from my end for now. I took around 40 minutes of your time, I guess. We'll move on to Q&A sessions. You can just unmute yourself or you can drop your questions in the chat box. You can always mail us and we'll be sharing our email ID after this presentation as well. So over to you, Aisha. I'm just
Yes,
in the chat box.
amazing. Yes. I am taking out the questions from the chat box. Okay, we have our first question. Child education, where my kid is 2 years old. Retirement fund started 5K in small cap fund, PPF for tax saving monthly 3K. I think would this be suffice? Would be the question.
I'm just looking. It's asked by Mr. Srinivas AL. So he has child education where his current kid is 2 years old. Retirement fund started. So probably I won't be able to tell you is it a right approach or not because I don't know you personally. I don't know what's your risk appetite. Again, I mentioned that to advise on anything, I just need to ensure, I just need to know that how much risk one is able to take and how long one is able to stay in the market. But from what I can say is that the person who's asked this question, Mr. Srinivas, has started saving for his goals quite early in his investment journey, and that's really very nice. Probably what he can do is he can connect us separately. I'll be sharing the email ID. He can just ping us and we'll get in touch with him and we'll advise him separately because this is very specific to a fund and an investment, which I cannot, I'm not regulated by SEBI as well to advise on something which is not before I know a person in detail. But yeah, it's good that he has started investing early.
Yeah, thank you, Kunal. Actually, I just gave those points. In the initial, you have asked what are the goals already. For
Right.
that is, it's not a question from my end.
Oh, okay. That's completely nice that you've started investing. That's what I told you that it's
Yeah,
really very nice that you've started to invest so early. It's really very good. Just ensure that you stay invested for a long term because your goals are quite far from what I
yeah,
can see.
understood. Thank you. Thanks for the session. It's very productive. Yeah,
Great.
thanks.
Thank you, Srinivas. Let's move on to next question. Should we take a risk of flexi cap fund if we are investing in SIP for 20 years?
Yeah, that's completely fine. So I told you, you just need to, I'm not able to, I cannot give you a particular scheme or something like that. But having exposure to flexicap funds is fine if your goal is long term in nature and if you're aggressive. That's completely fine. I'll recommend you if you're probably setting up a goal and investing in a particular fund, consult an advisor, not any agent or any distributor. So yeah.
If we start, is it safe to start an SIP through online brokerage app through Grow and Zero the app for a long time of like 20 to 30 years?
So I won't be taking any particular names, but as long as you're buying direct funds in a mutual fund through any route, it's completely fine. Because at the end of the day, the funds that you give to an investor, to a fund house stays with a fund house. So there's no risk of going through any route. Just ensure that you buy direct funds and you don't buy regular funds because regular funds come with a lot of fees, whereas direct funds don't come up with fees. The names that have been mentioned right now in this chat don't like they are not regular funds, they're direct funds. So they are good and probably you can continue for 20-30 years as well. Even if any company shuts down after 20-30 years, your money will still be with that fund house and you can directly log in through them and start investing. So that's completely fine. Yeah. And there are a lot of tools available, and Tavaga is also one of them, but we are focused on equity, ETFs, and index funds.
Okay. Hi, can we validate whether the service provider is SEBI RIA?
Yeah, so SEBI RIA generally basically means that registered investment advisor. So if an institution is a SEBI registered investment advisor, or if that particular individual is, you can probably check the website of that advisor. It's mandatory to write that whether you're an registered investment advisor or a distributor. You can always find that, or simply you can go on the SEBI website and check for that advisor. It's possible. Validation is possible. Yes, in short.
Okay. Apart that you have mentioned that stock doesn't work in long run. Why so, and what actions are required to take for investors already having stock subscription in their portfolio?
Now, I did not mention that stock doesn't work in the long run. I guess this question is around glide path investing, wherein probably stocks and equity instruments can have a volatile up and down nature, right? They can go up sometimes, they can go down sometimes. I'm not saying that stocks don't work in the long run. In fact, stocks will only work in the long run. Okay. They might work sometimes in the short run, trading by trading and stuff like that, but stocks work in the long run. But which stock work in the long run and how long, nobody knows that. There can be some periods of uh, downturn as well in the markets, like we saw during COVID. So stocks work in the long run, just that the stocks that have worked in the long run and where you have earned your return, you need to preserve that, because in the next 2 years they can go down again. Okay, they can go down 20%, 50%, like it happened during COVID. So, but you need not go through that journey, and that's why you need to save for that. So when what actions are required to take for investors? So as I mentioned, if you only have a stock subscription, that's not a better approach to go. You should have an approach wherein your entire wealth is being managed and not just stock tips are given. It's okay to have a stock subscription, but it's also mandatory, and it's mandatory as in it's recommended to have a proper wealth management approach towards investing, not only stock approach.
Okay, but somebody who's not a regular tracker of the market, and whether this will be the good idea to keep all the good or blue chip stocks in the portfolio and make it for a long-term investment purpose?
So blue chip stocks are kind of safe than small cap stocks. I agree with it. But blue chip stocks can also not give you any return for longer horizon. For example, Reliance Industries, now I'm talking about history and that's why I'm giving you talking by name, there was a time when Reliance Industries did not give a return for 10 long years. Zero return, absolutely. They went down as well during that period. There can be times when even good blue chip companies can give you zero returns, right? So that's why only stock investing is not suitable for investor, and it's not really very good. Having a good asset allocation of different instruments with equity, fixed income, and gold is necessary. Equities you can have for 80% of your goal time, but the last 10 to 20% you need to preserve your goal. And when you go by a stock subscription route, uh, probably you need to ensure that there's a good churning as well if you're investing, because if you just keep on investing and if the stock is not moving for 5, 10, 15 years, probably there's something that the market knows more than you know or the advisor knows. So that's why only stock subscription and only buying blue chip companies will not work. I'll be honest. So there are many companies, I just took one name.
Yeah, so you have suggested that one should be required to keep a trade oftenly on the stock part.
Come again?
You are suggesting that one should be having a trading activities actively
No,
involved in
no,
the
no,
trade.
no, 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 no. I'm not saying that you should be trading on your stocks, but you should be checking the fundamentals of the stock at least every year. Like, are they deteriorating? Are they doing good? And if they're deteriorating, why they're doing good? Why they're deteriorating? The best approach for an investor who's probably only wanting to invest in blue chip companies is probably go through the index funds route. You're hardly paying any fees to them, but you're probably taking less risk and probably you're doing better for long run. Reliance Industries, if it doesn't give returns for the next 10 years, it will automatically go out of the index. And if a particular stock has given you if a stock has given better returns, then it will take the place of Reliance Industries. That's how an index fund works, right? So even if that happens, so you are doing good by buying an index fund instead of just buying blue chip companies, and they take hardly any fees. So there are funds which only take 0.06% fees, which is less than what many things that you spend upon. So rather than buying blue chip companies, I'll recommend you go with an index fund. There's good amount of churning once every year or twice every year at max, uh, and takes care of your investments in the longer run. But don't trade just because a stock is not doing well or it's doing very good in the short term. Keep a watch and consult someone. That's a good approach to follow.
Okay, thank you.
Yeah.
Okay, I hope that is answered. Moving on, may I know how longevity is a risk, since as more time will go by, the capital will compound even further. Hence, isn't it more of a boon than a pain? I think this is related to the slide that
Yeah,
you have talked.
yeah. So longevity risk. So probably longevity risk is something that you have stayed longer than you were expected to. Now, this is right that your asset will compound for more time if you stay invested for a more time. But say after 65, 70, when you require funds to invest in the stock, when you require funds to for your retirement, you will sell those funds, right? You will sell a mutual fund, or you will sell your investments for taking care of your retirement lifestyle, right? If you sell those mutual funds with an expected time horizon of 10 years, that these funds will take care of my retirement lifestyle for the next 10 years. Say, for example, if you leave beyond those 10 years, then how are you going to manage that? So that is what I'm going to, that is what I was going to, I meant actually. So longevity risk is not good because you are going to live for a longer time horizon than you expected to, than you saved for, right? But that can be taken care by simply an annuity. Yes, if you stay invested in the market for a long term, your money will compound for a long term, for in a better way, but you are going to sell that instrument when you retire, when you need that money, right? Yeah, it's good boon as well as a bane.
All right. Yeah. Could you share your opinion about digital gold on Google Pay? And similar to that, another question, like gold, there is diamond investment concept also in the market. Is it good or bad?
I'll be honest, none of these are regulated. So as a SEBI registered investment advisor in the company that I work, I really cannot talk about regulated digital gold and diamond thing that you just spoke about. I'll probably discourage you to invest in all these kind of instruments, because the owner who is you probably giving out these investment options, the company that is giving out these options, probably knows that these are unregulated, and still he or she is having these options on on their portal. I'll discourage you because these are not regulated. In the event of any extremity, your investments can go, and you might not have any litigation, or not, you might not have any option to go in courts to claim these. So please, I'll discourage you to not go with these instruments as they are unregulated. Gold ETFs are regulated, sovereign gold bonds are regulated, digital gold isn't.
Okay. Can you show the slide with the amount of investment time recommended again according to the type asset? If you can just
Yeah,
switch.
sure. And you'll get a presentation of this after this call as well, right? Right, Aisha?
Yeah.
People will get what I just read about. I'll just go to that slide. So you can probably take a screenshot, or you can just refer to it after this meeting. You'll always get it. You can move on to the next question for now.
Yeah. Could you suggest me a best term insurance which has good claim and settlement ratio? I think that would be a hard pass, but you can connect with Nova for this. You can connect with Nova. We are in the insurance practitioners. We have Nova X as part that we just recently started to get your consultation. You can book the consultation for that as well. Just visit novabenefits.com and you will be getting you'll be able to consult our investment advisors for that as well.
Right.
Right.
So Aisha did a better thing by suggesting you, not just me to answer it. Probably that's what I will say. So even when you're buying any investment product, consult the professional, consult the company, because they
Yes.
have a good experience. So I'll recommend you to do what Aisha just said.
It's not again, it's we won't be suggesting any product specifically. Even Nova, we don't suggest any particular insurers or a plan or anything. We will tell you what is better, this is good, this is bad, and this is how you should choose. Rest is up to you. Even the financial advisors, they do that. They won't tell you you should do here or you should do that. It'll be more on that will be more personalization later on, but then the advisors are more likely to tell you that this is good and this is bad, and take an informed decision and include you in that decision. Just us saying that take this or buy this you'll 25 दिन में पैसा double that scheme doesn't work.
Yeah. So that all won't happen. Right. Absolutely.
Yes.
Good one.
I think we'll take a couple of few questions as well. What should be the ideal ratio of investment versus expenditure?
I'm not able to get that question. I just missed you.
Should be ideal ratio or ideal ratio of investment versus
Can
expenditure?
you tell me who has asked this question? Probably I'll read it.
Actually, Kumod had asked this. I came in my direct. Kumod, if you are here, okay, we can skip it then. Okay. What should be retirement corpus if we need to aim for? Like current age is 28.
So what we can do is we have our own retirement calculator with us, which has an inflation expectation rate, an interest rate expectation rate. As per the retirement lifestyle, the current expenses and your future goals after retirement, probably we can help you in giving it in a customized manner rather than just giving out a figure, because I don't know you in person as to who you are and how you like to spend. How many family members are there with you, who like how much care you want to take of yourself and your family members, medical things. So there are multiple things attached to it, and that's why more than telling you a figure right now or giving you a retirement corpus right now, it's best if we connect separately in a customized way, and I can evaluate properly, give an investment policy statement, and likewise we can determine. It's a better approach. Like, to be honest, I just for the saying stuff, I can tell you, you need 50 lakhs, you need 1 crore, you need 10 crore, because we see it with a lot of people, but it's not a recommended approach. I cannot just give out a figure to you. It's best if we connect separately.
Okay. What's your advice on ULIP investment? I'm just skipping few questions. Our next question is also about ULIP. So if you can shed some light on that.
Recommended approach to not go with ULIPs at all. ULIPs are very expensive instruments, and ULIP is an instrument which is probably given you by a bank person sitting in a bank and not an insurance company who has a target to achieve, right? What ULIP does is it takes money from you and it invests in mutual funds again, most of the ULIPs, and that they are for long term. Sometimes ULIPs don't allow you to sell your investments if you need money. Your money is locked in. Again, the instruments that are being used by the ULIP or the insurance company to invest your money in are again mutual funds. So there are a lot of layering of fees which is there in this. There are various other charges attached. Again, if you ask me on a 20-year horizon, if you're purchasing a ULIP, you'll get around 6.867%, which you can easily get by investing in a debt mutual fund at very low cost. As far as possible, avoid ULIP. Don't go with it. That's my opinion.
Okay. I think we have had enough questions and enough discussions. We will be sharing the deck with you shortly after this call. And thank you so much, everyone, for joining the call. Thank you so much for staying so long for this entire session. I hope you had a great learning experience, and also as well as how you have an idea of how to plan your financial goals accordingly for your next year. And thank you so much. I have dropped a link for both how to consult, how you can book a consultation with our Tavaga advisors, and also you can join our New Year's Eve music concert on Friday. I have dropped the link as well for that. Please do register for that as well. Thank you so much, everyone. Thank you so much.
Happy New Year to everyone. And you can always drop a mail on advice@tavaga.com as well if you have anything. Thank you so much. Thanks. Bye-bye.
Thank you, guys. Thank you.
Bye.
Bye.
Bye.